This is alarming. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, we have some new reports that are painting a bleak picture about the global economy. And you may remember from yesterday's show, we said we could be weeks away from a severe economic crisis. And now what we're seeing from these reports is it's validating that and showing that the situation is rapidly escalating. Let's go to Bloomberg, where we picked today's story up with a headline: U.S. jobless claims now rise to the highest since October of 2021, and a sign the labor market is cooling. Well, I'll twist that around, because it's not a sign the labor market is cooling. As I've suggested in past shows, when the weekly claims start to break over 250,000, I believe that this starts to spiral out of control. And I think what we're seeing is not the sign that the labor market is cooling, that we're about to see a whole lot more of unemployment claims. Let's continue on. Initial unemployment claims increased by 22,000. That's a very sizable increase to 264,000, breaking that 250,000 threshold that I've been calling for. Continuing claims, which include people who have received unemployment benefits for at least a week or more and are a good indicator of how hard it is for people to find work after losing their jobs, rose by 12,000 to 1.81 million. Now remember that 1.8 million has been pretty sticky here, but now we're starting to see an increase in initial claims. We'll be watching these continuing claims to see if people are actually getting back to work or if they're struggling to find work. But we can expect that if initial claims are rising, continuing claims should continue to rise. Now let's take a look at this next chart, because I want to show you, my line in the sand was 250,000 on, this is a 4-week moving average, which is sitting at 245,000. So we're pretty much there now. And you'll notice this red line across horizon, that is where 250,000 weekly claims based on the 4-week moving average hit. You can see we're almost there. And when we get to a situation like that, you have to go back to the 70s and the late 60s when we saw the same level get breached after very low levels of initial claims. So very similar to what we're seeing now. And next thing you know, they escalated, they shot straight up into a recession. And that, my friends, is the case that I'm making now. Applications for unemployment benefits have been trending higher in recent months as some pockets of the labor market have deteriorated. So we've been talking about air pockets. Well, here we're seeing one start to form in the labor market. And if this one takes off, it's going to be very, very dangerous. And this is already flagging a number of alarms, as layoffs that begin in white-collar sectors, including tech and banking, are increasingly starting to impact companies across the country. And what you start to understand is, as people lose their jobs and go on unemployment, their income drops. And if their income drops, then what in turn happens, their discretionary spending is the first thing to go away, because they still have to buy, food, rent, energy, these core things they need to do. Their discretionary spending goes down, and the next thing you know, that starts to have a broad impact on the economy as other sorts of parts start to slow down. And we can see that in this chart here. We look at manufacturers' new orders. This in red. These are durable goods shown on a year, on millions. I almost said a year-over-year rate change, but it's not against the 4-week moving average initial claims. And what this suggests is demand goes down. You see as the red line goes lower, what happens? Initial claims go higher. And this is a case that we've made on the show before that simply suggests that when demand falls and new orders fall, well, manufacturers don't need as many employees, so they start to lay off, and then it becomes a broad-based cycle where it feeds upon itself. Unless people can get back into the workforce somewhere else, which tends not to happen, particularly when you have a massive inventory overhang, the next thing you know, initial claims head higher. And of course, this was already predicted long ago by the yield curve. Now let's take a look at the 10-year, 2-year yield curve, that in red, with the inversion showing below the green horizontal line. You'll notice I marked these yellow lines that show when the curve inverts, you're pretty close to near the bottom of initial claims. And sure enough, we see that in the 70s. We see that in the late 80s, early 90s. We see that in the early 2000s. We see that in kind of the mid to late 2000s. We see that in the late rate, teens, all of this happening again, and now it is doing it once again, suggesting that the path now for initial claims, which again is a big alarm in the economy, is for it to go higher, suggesting we could be heading to recession much quicker than we thought. Remember, a lot of people have been saying second half. We've been warning this could happen a lot sooner. And as we turn to China, because this isn't just a U.S. issue, if we look over to China, we can see this problem's happening there as well. As China's main trade fair struggles to lure buyers as global growth slows. Now check this out. It says lackluster demand from the U.S. and Europe stall export efforts. This is a big problem because I want you to be thinking, when you think about China and you think about the U.S., remember the U.S. exports and inflation. That's what we send overseas. We send dollars overseas. China exports deflation, disinflation. So check this out. When we start to see a slowdown in China, it's telling us there are big red flags over here too. Millen Houseware, a producer of anti-slip mats mainly for American and European customers like Walmart and Costco, had a few of his target clients visit his booth. And what did he say? Demand is really weak in the U.S. now, something that was also apparent at a housewares fair he attended recently in Chicago. Our big clients aren't placing new orders as they're still digesting inventory, suggesting exactly what I just said. If you have too much inventory and declining demand for new orders, what do you not need as many of? The simple answer is employees. But digging further, now I wanted you to see what's going on in this China trade fair, because now we just got some hard data and it's telling us the slowdown is coming. Consumer prices in China rose a mere 0.1% in April, the slowest rate, again, disinflation in 2 years. But it's not exactly what we're concerned about in terms of their CPI, it's their PPI, the producer prices we want to look at. But one thing that should be going up quite a bit, well, that is your trades. And one of the easiest way to do that is start with our CTA-Timer Pro report, because it takes a look at machine positioning. It tells you on a historical basis what are at extreme highs and extreme lows. All you have to do is follow the report, find out when it says minus 100 across the board or close to it, and start your trades from there. Many of the people subscribing to the report tell me it has changed the game on how they trade, and their probabilities of success have gone straight up, because instead of chasing things already high, they're focused on things that are low. And now let's talk about something that's low and headed lower. And that's China's PPI. As China's producer price index, which measures prices paid by wholesalers, fell 3.6%. Economists surveyed by Reuters only expected a decline down to 3.2%. And why does this matter? Because, well, here you see producer prices. We're looking at economic activities, the industrial activities for the total for the People's Republic of China in blue. And look at this, the consumer price index, the U.S. Remember, China exports deflation, disinflation. Well, here it is into the U.S. You'll notice that as China, we see producer prices fall. What do we expect to happen is U.S. consumer prices to head down. By the way, those looking to get on the CTA-Timer Pro report, link in the description, 30-day money-back guarantee. So you get to try it out on me. Check it out. Don't like it, we'll give you your money back. No big deal, but you'll see it'll change how you trade. And now we're seeing, of course, producer prices here in the U.S. come down. No surprise. We've been saying this was going to happen. I'll show you why. As U.S. producer prices increase at the slowest pace since early 2021. Remember, everyone's been calling for more inflation, sticky inflation. Everything was going to turn higher. Now, while there isn't a direct link between U.S. producer prices and U.S. consumer prices, you do see they both tend to trend in the same direction. Let's take a deeper look at this report, and I'll show you the connection and how we knew it was headed down. The producer price index for final demand increased 3.2%, or should we say slowed to 2.3% from a year ago, the slowest pace since early 2021. Under the headline figure, 80% of the monthly rise in the PPI, we talked about this yesterday, we saw something similar with the CPI, was due to services, which included a number of things: portfolio management, food wholesaling, and a handful of healthcare related costs. Here we see PPI month over month down to 0.2%, year over year slowing to 2.3, the core slowing to 3.2. What's the driver of this? Well, my friends, it's crude oil. The biggest impact on, of course, producer prices is the price of crude. Here you see producer prices, final demand in blue, against crude oil prices. The West Texas Intermediate in red. And what do you know? As in West Texas Intermediate crude oil prices trend lower on a year-over-year basis, so too does a PPI, suggesting to what we already know is coming, that the producer price index is coming down, and eventually that will lead to lower consumer prices. Again, not a direct connection, but there is a relationship between the two. And some further evidence we see from that is now in box demand, of all things. Another sign of profound box demand weakness is appearing, check this out, as FreightWaves has written extensively in recent weeks and months about the weakness in U.S. box demand, an indication of the poor state of the goods economies as Americans are increasingly cash strapped. Well, perhaps the inventories are so high as top of this that we don't need boxes, and we talked about how discretionary spending is coming down. Well, if that happens, well, guess what? You don't need as many boxes, calling this a wonderful leading indicator as we see the three largest North American container box producers reported box demand declines ranging from 8 to 13% in the first quarter, demand being consistently worse than they expected over the past 3 quarters. So here we see on average about double-digit declines. Now, if we look at some other alarms, we have to focus on the debt ceiling here because, boy, everybody is sounding the alarm, and as I suggested yesterday, there would be some changes coming. Well, sure enough, this morning we got a report, but let's look at first what Treasury Secretary Janet Yellen has to say. Yet Yellen says the debt default would hurt the U.S. international leadership. As then we turn to Biden, he dials up the pressure. World is in trouble if we default. So here you're seeing from two, of course, our country's leader, President Joe Biden, saying, look, we can't do this. We're seeing from former Fed chair, now U.S. Treasury Secretary Janet Yellen saying, look, we can't do this. Boy, if we did this, everyone around the world would just turn their back on us. This can't happen. But look what's starting to change here, and I want to give you some perspective on this because everybody says that this would be outright disastrous. The odds of it happening are pretty low, but I want you to see what happens going into it is not what everyone suggests. As Biden goes on to say, higher interest rates for credit cards, car loans, and mortgages. He said payments for Social Security, Medicare, troops, and veterans could be delayed. Keyword delayed. We'll argue the higher interest rate factor in a moment. Our economy would fall into a recession, and our international reputation would be damaged in the extreme. We shouldn't even be talking about this situation. Well, the reality of it is, if you start to think about if the government were to stop spending, that would really start to push the economy into a recession because, of course, there would be checks that didn't get paid out. Now, we're already headed that direction, so we add on to this on top of that factor. But if it was only a week later or something short term and checks went out, it probably wouldn't have a major impact. But the idea that interest rates would go up here, well, that's contrary to history because you got to go back all the way to 2011. And back in August, we ran right up to the line on the debt ceiling. And if interest rates were going to rise, well, I'll show you what. This shouldn't have happened. And here you can see in August 2011, rates came crashing down, even though it was believed at the time we could see the very first ever default in government debt. And yet what happened is we saw a flight to safety from around the world. Rates came crashing down, and you'll note they didn't recover much. In fact, they just went sideways before crashing down again. So the idea here that we're seeing higher interest rates from a debt default, well, history says that's not likely either. But remember I told you yesterday, you look at who's each side. No matter which side you're on, if the power of the people is not behind one side or stronger on another side, you'll see some capitulation. Well, this morning we did. As White House takes signature law off negotiating table and early spending and debt ceiling talks validating, and we're seeing this in the bond market today, that's saying, hey, looks like we're getting somewhere. We may not get there in time for June 1st, but as long as they're talking, as long as they're negotiating, and as long as people are willing to, well, that means there could be an extension. We saw interest rates come down this morning, but President Joe Biden's drawing a line in the sand now. Check this out. As spending negotiations get underway, the White House has conveyed, and we said that this would happen. They would get down to negotiations. He would have to back off. The President Joe Biden said the Inflation Reduction Act was off the table, not going to happen. But he said they're looking at both sides to identify potential spending cuts. And among the other non-starters, he said, look, rolling back student debt forgiveness. Don't know what your opinion is on that, but he said not going to happen, even though it remains tied up in litigation currently. But here we see it. As part of these negotiations, sources on the inside said the White House is willing to entertain a cap on future spending, but for a far shorter period than the 10-year spending cuts agreed as part of the 2011 debt ceiling standoff. And in early conversations, White House officials have also indicated a debt ceiling increase will need to last more than 1 year to avoid the scenario playing out against next year. Of course, we know what's come, why they don't want it to happen this close at this time next year, because it goes right into the next presidential election. But all this says is the negotiations are happening. We said, look, if the polls are not behind the president, he's going to have to back off. He is. So we're seeing this. Will it get done by June 1st? Who knows? But if it doesn't, the alarm bells will certainly be ringing, as this will help push the economy into recession. But I imagine it won't happen. It's never happened. And so the odds of it this time are pretty low. But if anything repeats like 2011, look for interest rates to go down, not up. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.